welcome to Market Drop, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICIdirect. Very good afternoon, Pankaj, and thank you so much for joining in.
Yeah, hi, good afternoon, Geetu.
Pankaj, let's start with the markets as usual. Another volatile week with Nifty for once reclaiming 18,100 mark, but yet again failing to sustain about that 18,000 crucial mark that we see for Nifty. And we saw some kind of a sell-off on Friday session. How long do you see this kind of a range holding for Nifty? Any breakout probability that you see for Nifty, say, in coming weeks?
So, Geetu, you're right. Market has been in a consolidation or a corrective phase for the last 2 months after hitting a lifetime high of 18,800. But what we see is that there are some things which are sort of changing for good. One, obviously, is that we expect Indian markets to sort of do a bit of a catch up because most of the global markets have been sort of trading positive since the beginning of this calendar year. European indices are actually at lifetime highs, whereas US after recovery is sort of consolidating at those levels. So, which is why we expect India to do some bit of a catch up. I think market breadth
Okay.
was particularly weak in the month of Jan, about zero point 0.9. Now that has sort of improved in the month of Feb to about 1.2. So that's another positive sign. And we all know that the FIs have been on a selling spree for quite some time, especially in this year. And this got intensified when we had this Adani-led volatility in a number of stocks. But lastly,
True.
we have seen FIs turning sort of net buyers to the tune of about 5,500 crores. That is another positive. Other thing is that there are a lot of sectors which were sort of not really performing. I mean, auto did perform in bits and pieces, but auto is now sort of shaping up well. We've seen oil and gas sector after a long period of time sort of doing well. IT this year has started to sort of do well. So what we are seeing is that some of the traditional underperformers, so they have started to sort of do well, and which
Okay.
is why we are sort of quite hopeful that things are turning for better. And even when you look at index heavyweights, be it Reliance, HDFC twins, or Bajaj twins, Infosys, ITC, Tata Motors, all of them have, or the chart patterns for most of these stocks have started to look better. So all this is
Okay.
sort of suggesting a possibility that the market will sort of break out of this 10-week range, which it had been struggling with. So our sense is
Okay.
that once it sort of crosses probably 18,200, 300 levels is on the cards.
Pankaj, but what we see is that even if the index is holding up, mid caps and small caps are being thrashed. If we talk about the mid caps, for some companies, the earnings have been 20 to 25% higher, but the stock price has been 20 to 25% lower. Why is that happening?
So one is when you sort of segregate the markets between say large caps, mid caps, and small caps. Now, mid caps is one segment where the overall valuations have been richer compared to say traditional large caps and or small caps. And wherever and a lot of these stocks were priced to perfection. So, for example, you take Relaxo
Okay.
as a company. I mean, good times they used to make gross margins of 60%. Now that has sort of come down to 40%. So whenever some of these better price stocks or stocks which are priced to perfection, say for example Page Industry, so whenever there is a slight earning miss, the
Okay.
kind of punishment what you get for the stock is quite high. Compared to that, when you see large caps or even with smaller caps, I think those are slightly better placed because one, while the growth rate is largely been there across, but if a segment is priced to perfection and if there are any sort of dent in those perfections, then the market has been sort of quite punishing those set of stocks. So
Okay.
our sense is that large caps and small caps are relatively looking better. There were a number of mid caps which are priced to perfection, and I think they've taken a good amount of beating in this recent
Let's
correction. Yeah.
Yeah, let's now talk about another asset which is doing well. Gold prices are up 13% in last 4 months. Should one be increasing weightage to gold, as a part of his or her portfolio?
So, well, yes, gold prices globally are up 13%, like you said, in last 4 months. But when you sort of look at the rupee prices, I think it's even more better because we know that rupee also has been depreciating. So, say, for
Mhm.
example, in last 2 years, gold has delivered 28% kind of a return. Last 4 years, 78% kind of a return. But when you sort of look at it from a very longish perspective, say since 1970s, gold has delivered 9% CAGR kind of a return. Now,
Mhm.
if gold has already delivered 13% of return, so then it means that whenever the asset class has done generally better than their historical average, this is not the time to turn bullish. And which is why we are not saying that people should turn bullish on gold, but gold is a
Okay.
good hedge against the global volatility. And so from that perspective, I think a 10% allocation of one's portfolio can be in gold.
Mhm.
But I think rather than physical gold, suggestion would be to sort of hold the gold in sovereign gold bond funds, where you get two
Okay.
and a half percent additional interest plus. Now you don't have capital gains tax, so that's a sort of added positive. Otherwise,
Mhm.
I think one should not turn overtly bullish on gold because
Okay.
globally things are still not certain. I mean, gold did well because there was an anticipation that there'll be tempering of the inflation numbers in US, but the inflation is still sort of proving to be sticky. So I
Right.
think normal allocation of 10% is what the maximum one should think.
Mhm. It is usually said that if you have higher inflation, so gold is a safe haven. You can, put some allocation to gold, as you were suggesting that 10% of the portfolio can be in gold bonds. Talking about the earnings, Pankaj, quarter three earnings are more or less over. So, what are the key takeaways from the earnings season this time? And do you see any kind of upgrades or downgrades as far as the companies are concerned?
So I think the key takeaway from this entire earnings season is that margin recovery was one of the highlights of the quarter, which we have seen. Margins came at about 17 odd percent. Prior to that, in the Q2, we had literally 2 years of lowest margin, which we have seen below 15%, about
Mhm.
14.7%.
Mhm.
So we have seen a good margin recovery largely because of lower raw material cost. And on a top line basis, top line was largely flat on a quarter-on-quarter basis. I mean, whether you include banks or without banks. But since there
Okay.
was a margin recovery, so EBITDA growth was 16%, and we have seen 16, 17% kind of a bottom line growth as well. EPS
Mhm.
came out to be better at 205 for Nifty. Compared to that, we were expecting 195. And I think
Okay.
sectors which have done well is auto, capital goods, FMCG, pharmaceutical, and metals and oil and gas still sort of continue to struggle. But I think auto was the biggest positive surprise, and that is one space where most of the companies have outperformed in terms of margin profile. I
Mhm.
mean, case in point being Tata Motors, which has posted a profit after 7 quarters of loss.
Mhm. Mhm. So the post quarter three earnings, what are your targets set for Sensex and Nifty?
So largely, we are still sort of expecting 15% CAGR kind of a growth in Nifty for the next 2 years till 25. I mean,
Mhm.
our FY25 Nifty EPS is somewhere about 1,090.
Mhm.
So from that perspective, 21,500 is still what we are maintaining. Now, the
Mhm.
challenge is that while the earnings have been good, the market price performance is really not in line with expectation. And that is the beauty of the
Sure.
market. I mean, it does not really sort of trend all the same time at the similar pace with the earning growth. So there will be a
Mhm.
point in time when probably you may not see earning growth, but market will do a lot more better in terms of price performance. But
Okay.
on a longish period, typically market toes the line of earning growth, and earning growth is a bigger variable according to us than the actual price performance, and which is why we are maintaining the target on Nifty.
Okay. Let's now talk about IT sector. IT sector is holding up quite nicely in 2023 so far. So what is that you are doing in this space? Which are the stocks that you think should outperform?
So IT is sort of benefiting from number of things. One is we are still seeing clients continuing to sort of spend on transformational journeys or transformational projects. Now,
Mhm.
as a thumb rule, if they were spending say 100 rupees now, that has sort of come down, but it is still good at about 85, 90 dollars. So it's down only by 10, 15 odd percent. And then we are
Mhm.
seeing a lot of cost optimization deal, largely to sort of save on cost, and which again is sort of helping do more of transformational journeys for a lot of these companies. So deal
Mhm.
pipeline is good for most of the companies across. There's some bit of a stress in only select pockets, say for example, retail, telecom, or high tech. But in general,
Mhm.
things are good. Margin profile is sort of getting better because we are behind the peak attrition levels. And I think one more positive is that the some of the tier one players will be beneficiary or are benefiting from the vendor consolidation as an opportunity. And I think
Mhm.
there are new technologies which are sort of getting adopted. So you have AI, which is expected to sort of witness a growth of say 20% CAGR. So that is a big interesting opportunity which is coming up. But yes, there are some negatives as well. So you still have attrition higher in niche categories or for niche skills.
True.
And
Mhm.
then obviously there'll be a worry that while the TCVs are or pipeline is good, but whether it will sort of get converted into contracts or not is remains to be seen. But
Okay.
overall, IT companies have been sort of shaping up well. And I think what we like the most is Coforge. Here our target price is 4,870. Now,
Mhm.
one is this company is going to deliver, or the management has guided for 22% constant currency growth, which is one of the highest growth. Even for next year, the growth is expected to be in mid-teens. This company has got the lowest attrition of nearly about 16 odd percent. Travel
Okay.
vertical, we all know that globally has been started to sort of do well, which is 20 percent of its revenue mix. That pie is up 25% compared to pre-COVID levels. Insurance vertical, there is a leadership change they have done. So that is another vertical that should do better in terms of growth. So we're expecting good set of numbers or a good set of growth from this company, 17, 18% kind of top line growth and 22, 23% kind of a bottom line growth. So I think Coforge looks good to us in IT space.
Mhm. Coforge is a good stock, as you have been suggesting in your previous sessions also. But Pankaj, there's a one question which most of the viewers really want to know: is it better to stick to the second rung or mid-sized IT companies, or should one again be with the big heavyweights?
So obviously the heavyweights have challenges in terms of size, whereas the tier twos typically do better in terms of growth rate because of the lower base. Now, if the worry on the macro is not really sort of panning out, then we would want to believe that even the tier twos will do well. Because initially the worry was that you'll have macroeconomic worries will sort of stem and there is a
Right.
possibility of a recession in the US. And possibly that could have impacted tier two and tier threes. But I think
Mhm.
that does not look like the case given the strong job data or most of the retail sales data, what you see is pretty strong in US.
True. Power sector has been underperforming quite for quite some time, despite of the fact that government has been putting pressure on reforms in this sector. We have not been able to come out of the worst. So, what is expected from this sector?
So last 10, 12 years, nothing happened in the power sector. Most of the stocks haven't sort of done anything, even from price perspective. And there were a couple
Mhm.
of reasons for it. One is I mean, till 2008, a lot of aggressive bidding happened, and that led to sort of unviable projects, especially by private players. So pricing had sort of got distorted. SEBs
Mhm.
continue to remain inefficient, so that had impacted the entire value chain. And then obviously the industry was transitioning from, say, thermal to renewable energy. So that also had a fair share of impact overall. But I think
Mhm.
things are sort of changing for better for this sector after a long period of time. One, I think the government is forcing SEBs to turn a lot more efficient by mechanism like smart metering. So they're linking state fiscal deficit with power sector reforms. Then I think we have seen good amount of renewable energy capacity addition, and the tariff there are largely sort of aligned. So earlier we had a good amount of volatility in tariff for renewable energy.
Mhm.
And overall, our sense is that things are sort of shaping up better for most of the players. But I think we will sort of prefer traditional players like, say, NTPC, because this is one company which has been adding capacity on the thermal or on the renewable side in the last 5 years. I mean, they've got a 24% market share in the overall power generation. Good part is that while the demand has been intact at 7, 8 odd percent, but what our sense is going forward will be that the PLF will sort of keep inching up because this company already had a capacity. So plant load factor or utilization will keep on improving. And if it crosses beyond 85, you get incentives also.
Okay.
And company is not really sort of behind in terms of new initiatives. So they have tied up with Nuclear Power Corporation of India for nuclear energy. They are doing pilot basis hydrogen project also, and then they are building up a good renewable energy capacity also. So from that perspective, our sense is that this company is sort of doing all the right things in the right direction and trading at a quite an attractive value of about 1.4. So our sense is that this stock, given the fact that hasn't really done well, is probably a good risk reward with a target price of say 205. So 204. So from that perspective, NTPC after a long time looks good to us.
Because these stocks have not been moving for long, they are stuck
Absolutely,
in a range or consolidate for long, and people
absolutely.
keep waiting. Now it seems that since you have turned positive in NTPC, and people should viewers should look and put some emphasis on picking up MTPC for their portfolio. So let's now talk about hidden gem, Pankaj. So in this volatile market, what is that you'll talk about as hidden gem for this week?
So hidden gem is Bosch, where our target price is 20,000. We all know that the love for SUVs is quite high. And in fact, the overall market share for SUV is nearly sort of crossing 50%. And Bosch is a sort of a technology leader in the automotive side, industrial technology. So largely 85% of the business is coming from mobility solutions, which is automotive products. And typically, it is largely dependent on mostly on diesel, and we all know that SUV as a segment has been sort of doing well. And plus, they've got all the kind of technology, whether it is for flex fuel, BS6 phase transition, EV, and hybrids.
Okay.
Nothing wrong. So they're not sort of technology deficient. Then I think our sense is that overall, with good focus on the growth, you will see about 18% kind of a CAGR growth in top line. Then you will see even margin profile sort of improving to about 14.5%. PAT growth is expected 23%. And the capex cycle is good, so CV sales is also good. So that is also a positive for this company. And I think this company has turned or has been reclassified as large cap from mid cap. So we expect additional inflows as well because of higher institutional participation and fund buying, and which is why we like this stock with a target price of 20,000.
As far as the value of the stock is concerned, it is a bit higher. So how should a retail investor approach this kind of a stock?
So I think this is one basic challenge with most of the people is that people think that if it is a 5 rupee stock, 10 rupee stock, that is cheaper, and if it is a 20,000 rupee stock, that's expensive. I think the basic approach should be that while yes, the minimum ticket size which will be required to buying this stock is say 18,000. So obviously that is the only hitch. But uh, just because the average or smaller ticket size does not mean that the stock is cheap. It could be a value trap also. So from that perspective, that should not be the barometer for judging the company. And I think the company should be judged more on the fundamental basis. And I think Bosch that way is a fairly well-known name. It has been a value creator or wealth creator for a long period of time. So I think people should not worry that just that since it is a 18,000 rupee kind of a stock, it's very expensive.
And the investor can also do a SIP with stock. I mean, they can buy a single stock in a month and then keep on accumulating, right?
Absolutely, absolutely.
So Pankaj, how do you approach the market for next week? We don't have any important data.
So next week we have US GDP data. The growth is expected to be 3.5%. So see, while the US Fed has increased the rates by 4.25%, inflation is still sticky. So overall GDP growth rate is expected to be good. So in a way, it is sort of turning out, the narrative is turning out to be positive that despite aggressive rate hike, the US economy is not really sort of entering into a recession, which was widely anticipated. So it's sort of pretty standing strong. And GDP data is probably going to sort of be a confirmation on that particular narrative. But
Okay.
overall, our sense is that Indian markets should do a catch up, and then there are some sectors or sectors which haven't really done well. So all of that should do well. And then FI is turning into net buyer. So I think market should, or we would expect Nifty to do some bit of a catch up from current levels.
Thank you so much, Pankaj, for your time and your views on the markets.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.